engineering. We have researchers working on supercritical CO2 power cycles for solar thermal power plants, on numerical methods for difficult thermofluids problems like inertial confinement of nuclear fusion, and on modelling to better understand the levers for optimal integration of wind and solar energy into large power grids. And I'm pleased to welcome our wonderful panel of speakers who you can see on your screen at the moment. So Bethany Frew is our first panelist. Bethany is a senior engineer at NREL, the National Renewable Energy Lab in Colorado. And Bethany's research focuses on capacity expansion and production cost modelling with a special interest in electricity market related research questions and very high renewable futures. Bethany did her PhD at Stanford University, focusing on quantifying the effects of aggregating electric load and renewable resources across large geographic areas and determining how to integrate large amounts of renewable energy into the US electric grid as economically as possible. Our second speaker is Julian Eggleston. Julian has spent much of his career really at the intersection between power systems and applied economics, which is the arena of electricity market design. So Julian's currently employed at the Australian Energy Market Commission, AEMC, as a technical specialist, predominantly working on power system security, rule changes and reviews. Those of you outside Australia, AEMC is responsible for managing the process of updates and changes to our market rules. Julian was previously at NEMCO, which is now called AEMO. He was in the planning team there. And before that, he was with GEC Alstom, which is now GE. And he's been at the University of Western Ontario in Canada and with GEC in the UK. Julian studied on both sides of the Tasman Sea. So his first degree was in engineering, and he's got a PhD in electrical and electronic engineering from University of Canterbury on computer modelling of harmonics. And he's got a master's degree in economics from the University of New South Wales. And our third panelist, final panelist, Ezra Beeman, is Managing Director of Energeia, a consultancy that provides research advisory services to organisations focused on the latest technology and the electricity industry. And he's also Managing Director of Empower Energy, which is a technology development startup. Ezra was previously at Energy Australia, which is now called Ausgrid, where he was in the pricing, strategy and project development areas. So Ezra brings a very sort of commercial focus to our discussions today. And Ezra originally studied economics and philosophy and later did an MA in applied finance at Macquarie University in Sydney. Just a little bit about myself. My own journey has taken me from energy efficiency program design in Australia and Southeast Asia, and then climate policy modelling in Hong Kong in the 1990s, to electricity market design and geopolitical gas pipeline developments working out of London in the 2000s, through to an industry analysis team in one of the big mining companies grappling with some of the big strategic questions. In the 2010s, I worked there in relation to the future of coal and the future of uranium, which means, of course, understanding renewables and gas and oil and all those interesting things. Okay, so what do we mean by market design, and what do we mean by electricity markets? And I think the plural in markets is very important. I thought just before I pass the microphone to our panelists, I just wanted to share with you a little diagram that I have created. I found it helpful for myself, both as a framework for my own thinking and to refer to in conversations about electricity markets. So I thought I'd use this just to set the scene today for our panelists and to provide a little bit of structure for our discussion so that we don't get too lost in what is a really enormous topic. So what you see here is a log scale. And this spans a century of time. So from a century in the future all the way back to real time. So think of this as a constantly scrolling series of time horizons spanning 12 orders of magnitude. So that's a trillion-fold difference. And when people talk about electricity markets, they're usually thinking about just one part of this timescale. My PhD student told me just yesterday that he's been looking at papers on unit commitment, and he said, Stephen, these people talk about 2 weeks as long term. So I think understanding what time frame we're talking about is really important. Now, close to real time, what we're concerned about is strength and stability and security of the power system. Julian's going to talk a bit about that. And then we think about reliability and energy security more generally. And environmental sustainability is, of course, a sort of longer time horizon issue. Now, the energy spot market is sitting right in the middle of this timescale. And that's at the core of many market designs, including the Eastern Australian National Electricity Market, which is 5 interconnected regions. We call it the NEM. So this, of course, is the problem that was solved by Professor Schweppe and his colleagues at MIT in the 1980s. And the link that I provided for some pre-reading to Bill Hogan's article is sort of extending that thinking a little bit into scarcity and abundance pricing. So our spot market here in Australia exists in a daily cycle of bids managed by Tarun's colleagues at AEMO for the 5-minute to half-hour time windows. And there's more than about $15 billion churns through that market every year, about a little bit under 200,000 gigawatt hours of energy. Next thing to think about is futures markets. So futures markets exist on financial exchanges, so separate from AEMO, and in the sort of quarterly, monthly, yearly window. We don't in Australia have separate day ahead or week ahead markets, but you might think of contracts internal between retail and generation arms of businesses and over-the-counter contracts as sort of bridging that gap there. And then we can think about investment decisions. So investment decisions need to look ahead a decade or 3. And investors are increasingly, but not exclusively, thinking about environmental sustainability when they make those decisions. And the link that I provided in the announcement to the interview with Josko and Schlemenzi, reflecting on their 1983 book, talks a little bit about the investment issue and the investment problem. During some research that we did in 2017, every banker we talked to told my colleagues and I that no one can produce a bankable price forecast of the Australian electricity market today. So what that means is full financing requires power purchase agreements, typically sort of up to 5 years ahead. And then the sort of years 6 to 15 are uncovered for financing. So I think these are actually non-trivial issues when we think about market design. And of course, the one thing that makes electricity markets very different from any other market is that electrical current must be produced to the millisecond at the moment of consumption, giving an exact balance between power supply and demand, and stable grids are based on that principle. So, of course, when system frequency diverges from the nominal, it needs to be arrested and then rebound and recover. And so AEMO actually achieves this with 8 frequency control and ancillary services markets, FCAS markets. So they've got regulation markets, and then regulation services, and then contingency services, fast, slow, and delayed contingency services. And then on longer horizons, they can use the reliability and emergency reserve trader, or the RERT function, to take all reasonable actions to ensure reliability of supply by negotiating and entering into contracts to secure the availability of reserves under reserve contracts. So those contracts are deployed when the supply side of the market and the demand response, we mustn't forget about the demand response and interruptible load contracts, when that is not sufficient to ensure supply reliability. And of course, the last ditch is if you can't retain system stability, then your last ditch is emergency load shedding. So, but of course, if we get too much of that, then that suggests our market's not working very well. Okay, now Bethany and Julian, so that's the sort of framework I just wanted to share with you. Bethany and Julian and Ezra are each going to spend about 5 minutes sharing with us their thoughts. And then I'll ask each of the panelists a question to get the discussion underway. Now, while Bethany and Julian and Ezra are speaking, please use the Slido tool to ask a question that you might have. So if you go to slido.com, SLIDO.com, and just type in ESIG-1A, ESIG-1A, then it'll take you to our little Slido page. Pop your questions in there, not in the WebEx window. So the hot tip, you can vote up good questions that you like. So the hot tip for your question to be voted up is keep it short and sweet and end with a question mark. We're happy for you to be anonymous, but if you would like to put your name with your question, that's great. And Taru is able to turn on your microphone so that you can, if your question's selected, we might ask you to read it out for everyone. And then we could ask, clarifications and things like that. So keep an eye on the questions in Slido, vote for the ones that that you like, and then that'll answering your questions will take us through to the top of the hour. So Bethany, the floor is now yours.
Thank you, Stephen. Not sure that the slides are progressing. There we go.
You got it, yeah.
Yes, excellent. Thank you. And hello, everyone. I'm excited to be part of this panel. I'm going to spend my 5 minutes talking about a new modeling tool that we're developing at NREL called the Electricity Markets and Investment Suite, or EMIS. And there was a comment made during the session that was held earlier this week about how simulation tools might not be the highest priority item as related to market design. But I'd like to argue the opposite during my brief remarks here today, that we actually need new modeling tools, specifically because wholesale electricity markets exist in many places, and so the need to be able to model those is obvious. Also because markets not only impact the operational outcomes within these different systems, but they also impact investment decisions. This obviously gets really complicated for the reasons that Stephen mentioned, because you have PPAs and contracts because of all the financing elements, and this is part of the complexity that exists within the interaction between markets, operations, and investment decisions, and is really a crux and kind of a core part of the work that we're doing with this model that we're developing. But investment decisions are a key component of as related to market designs. And this last point here is that current leading models, specifically those related to investment decisions, don't sufficiently capture some of these market structure effects. And so an example here is that traditional capacity expansion models that are built with a linear programming formulation that have a central planner minimizing overall system cost inherently guarantee cost recovery. But that's not the real world. There's a lot of imprecision that exists in how investment decisions are actually made. And so because of some of these complexities and nuances, and I've listed some additional complexity elements here. I don't want to spend too much time going through those, but I think probably preaching to the choir on many of these points. But the need to be able to capture some of those elements and the interactions and the nuances becomes increasingly important as we start to consider the impact that these market rules and different mechanisms can have on not just operations, but on investment decisions and in turn reliability. So what are we doing at NREL? We're building a new capacity expansion model that's focused on some of these market structure issues. Within this tool, we have investor heterogeneity, imperfect information, and uncertainty, and the combination of those things allows for recourse options. So as the future plays out, and it may not play out the way that those investors thought reality would happen, they can make recourse decisions to course correct. Another key point here is that we're linking with a broader modeling framework that's also being developed at NREL called SIP, the Scalable Integrated Infrastructure Planning, and that gives us access to a broader set of capabilities, which historically would be very siloed modeling domains that now we can have greater interoperability. This image on the right-hand side is an example of how we could use this tool to evaluate not only a static system with a given market design, but the evolution of market design over many years and the corresponding evolution of the grid as related to investment decisions. Not saying this is what will happen, but just saying this is an example where we could evaluate, for example, going from today's energy, ancillary service, and capacity set of products to a future with a much broader set of products that signal and compensate for those different grid services and attributes. So we're doing this through this EMIS model that I mentioned on the first slide, the Electricity Markets and Investment Suite. There's a conceptual image shown on the right-hand side here, but the key idea is that you have individual firms who are each maximizing their profit with some expectation of multiple possible operational futures. And within each of those operational futures, you have a central operator who's minimizing cost across some customized set of market products. So the end user can define whatever set of products that they want to define the quote-unquote market design that you want to study. There are 3 model formulations that we've developed as part of this tool that capture collectively the spectrum of market and behavior dynamics, with the sort of microeconomics textbook classic example of perfect competition on one end and imperfect competition on the other end. Ideally, we would be using complementarity or equilibrium modeling to get to that imperfect competition endpoint, but it turns out that that's not tractable in the specific formulation or application that we have here. So that's led us to 3 different formulations. I don't have time to talk through all of those, but we are working on some papers right now and hope to come out with those later this year to document and demonstrate the capabilities within each of those. So I want to wrap up with that, just a quick 5-minute talk here, and want to make a few last notes here. One, acknowledging the full team who has been working on this EMIS model development, doing some really good work. Sarab Dalvi, Bashar Anwar, Gord Stephen, Dave Biagioni, Sean Erickson, and Maxwell Brown. And then on the left-hand side, there is an image here from a report that we did, I think 4 years ago now, talking about basically the future market designs with zero marginal cost pricing. And the point here is that markets, wholesale electricity markets, have inherent flaws within them before we even start talking about zero marginal cost resources that preclude these markets from being able to guarantee cost recovery with marginal cost pricing alone. And so absent any sort of out-of-market mechanism or administrative pricing or some of these other mechanisms that have been discussed broadly throughout the literature and that I'm sure we'll get to the rest of this panel, we can't guarantee reliability with marginal cost pricing alone because of these factors. So unless we can solve all of these things, we need to talk about some additional kind of patches or fixes. So just want to keep that in mind before we focus on zero marginal cost pricing alone, that there are these other flaws that have already been existing. So thank you very much.
Bethany, many thanks for that wonderful, wonderfully succinct overview of what is an enormously complex and ambitious and challenging modelling project that you've got going there at NREL. I will ask you questions about that a little bit later, but now it's time to hand over to Julian, who is going to talk to us about essential system security services. Julian.
Yeah, thanks very much, Stephen, and thank you for the opportunity to participate in this panel. Yes, I'm going to focus on integrating essential system services into the market design. For many decades, the power system was vertically integrated and it was dominated by large baseload synchronous generators with some hydro and peaking plant. And the role of power electronics was very limited, normally just to DC transmission and voltage control. So the focus was on meeting growing demand and improving efficiency. And over this time, the stability of the power system became quite well understood. So could we click on, please? Yeah, thank you. The microeconomic reforms of the 1990s led to the introduction of the electricity market. The main focus was again on competitive markets for energy and the regulation of monopoly network businesses. And power system security remains still well understood. So one more click, please. Now, after a while, increasing quantities of wind and then later solar generation began to connect. And this had some initial concerns with just including this into the dispatch processes and the performance during disturbances. However, as the penetration of inverter-based generation increased and the demand side slowed, the market share for existing baseload generators declined. This led to some older units retiring and other units operating less often. So the once well understood power system is becoming much less well understood, with increasing challenges with conventional frequency and voltage control and emerging issues such as inverter-driven instability. Now, as the market and system operator, AEMO is undertaking a number of studies to identify the future needs for the services and a roadmap to coordinate the development of the transmission and network with the generation. So I'll just click on to the next bit. So in addition, the Energy Security Board is working with the market bodies on its NEM 2025 project. This is considering the changes needed to the market arrangements for the transition and beyond. This project includes work streams on the development of new and existing essential services. At the same time, the AEMC, where I am, is undertaking more immediate reviews and rule changes on issues related to system strength and inertia, incentives for primary frequency response, and operating reserves. So the AEMC is consulting regularly with the other market bodies and with ESB to coordinate our work with the ongoing work of the ESB 2025 project. So there's a number of factors that need to be considered when essential services are integrated into a market. Obviously, the nature of the services required, which is AEMO has been looking at, the characteristics of the equipment that provides these services, and how the existing market arrangements work, including the roles for bodies like AEMO. Also, determining the system needs and market arrangements is quite difficult because you can't consider the services in isolation. For example, the levels of inertia, fast frequency response, and FCAS are all strongly interrelated and somewhat substitutable. Also, different technologies provide different combinations of services in varying proportions. And some newer technologies are less proven and may not be fully substitutable for existing technologies, at least in the short term. Also, some services are more suited to being co-optimized in real time. For example, any dispatchable generation or storage can be used for a combination of energy and the different operating reserves, including for frequency control. And this will depend on the relative value of these services at that time. While other services like inertia are quite lumpy and can't be dispatched actually in real time, but need to be coordinated, committed. Okay, so the way we are tackling this is with 4 Ps. Planning, who determines how much of the services are required and to what standards? So who procures the services and with which mechanisms? How the prices reflect the benefits of the services, as well as incentivising short-term use and long-term investment in the services. And who pays? And this will be based on who benefits and who causes the need for the service, as well as who's best placed to respond to these signals. So we're using a combination of the following models, which is actually quite similar to some of the things that Eric was talking about on Tuesday. A mandatory provision through generator standards. So this one size fits all will work quite well for some things, particularly technical performance, but it can lead to over or underinvestment in different services at different times and locations. A decentralised approach where a competitive market plays a role in the coordination and delivery of the services. Now, procuring through a spot market is likely to be quite efficient in the short term for some services, but it may not lead to long-term investment signals for capital-intensive solutions. And a centrally coordinated approach is where AEMO is the market operator and system operator, and the network businesses plan and procure the services, and this could be through a combination of contracts with market participants and with network assets. So I've tried to give a quick overview of everything, why the power system needs are changing, and introduction to some of our thinking. It's obviously quite a complicated set of issues and needs a broad set of skills to resolve. Yeah, thank you.
Julian, thank you very much for that. And like Bethany, you prompted some questions in my mind, which I'll come to. But our next speaker now is Ezra, and Ezra is going to talk about the potential for changes in network pricing to unlock P2P trading, optimal DER investment, configuration and operation. All yours, Ezra.
Thank you, Stephen. As an economist and looking at the opportunities here, I think the topic that I have chosen to focus on is what I believe as an economist to be one of the single greatest barriers to DER, or really efficient power system investment and operation over the next 10 to 20 years. And it's really due to current pricing arrangements. And as a former network pricing manager, I've had some time to think these things through. But I would say this is really a very high-level illustrative approach that will hopefully open people's minds and eyes to the current situation and the damage that it's doing. So in the top left hand, I've put together an example of current bundled network tariffs, and you see the NEM consumer, and I've assumed about a 24-cent levelized cost at the retail level. And I've broken it up by the major sort of cost drivers, who gets what. AMO gets about $60 a megawatt hour on average. You've got transmission with around 10% of the cost stack. The rest of it's going to DNSPs, or distribution network service providers, and retailers. I've also indicated anybody who's selling their excess power, the DER seller, and I'm assuming that that's via a feed-in tariff, they get about 10 cents. Now, under the current rules, you can't actually do peer-to-peer trading very well, because as soon as you want to export any of your power and sell it to your neighbor, the neighbor really has to pay for the full whack, assuming that that power has come from transmission down through subtransmission, high voltage, low voltage to their house. And it really undermines the peer-to-peer or any sort of locally optimized system operation or investment. Alternatively, we could see a unbundling of the network tariff that would only charge the DER consumer that's buying from their neighbor on the left on the LV network for the use of that LV network. And so I've taken the LV network and I've used the ratios shown on the bottom left side, and I've not just sort of charged it to the consumer or to the seller. I've split that fee, and that's something that's being discussed at the moment, so that the consumer pays half and the seller pays half. And then what I've said is, well, if you look at the level between what the DER seller is currently getting and what the potential DER consumer is currently paying, that's about a 15-cent payment for the DER transaction, which would be a significant reduction in price or cost for the DER consumer that's on the LV network, and a significant 50% increase on the amount of money that the DER seller would be getting. This sort of arrangement would respect all current rules that I'm familiar with. Now, that's fine on a levelized basis and on an average basis, but the opportunity here is significantly greater during the peak period. So what I've done on the bottom right side is I've looked at the current NEM consumer, and I have assumed a cost-reflective peak price. And when I say cost-reflective, I mean it, and that this is designed to be reflective of actual costs. Currently, peak prices in the market, and this is similar to anywhere in the world, don't really reflect peak prices, and that's because prices are generally set more for political reasons than for scientific considerations. But if you were to actually price them at what it costs to provide incremental capacity, again, I've given some illustrative numbers on the bottom left, and you spread those over 1% of hours during the peak period, and I've even assumed that the investment's not going to be for 20 years. You get the sort of prices that we're showing on the left-hand side compared to what the DER seller is getting. Now, under an unbundled framework where you also had truly cost-reflective infrastructure prices, and it's not just network, but also through the generation, assuming about a $250 per kVA per year price, you'd see that the consumer would pay about 76 cents compared to what they're currently paying, about $1.60 in terms of cost. And the DER seller would get somewhere around 76 cents per kilowatt hour. So again, moving to a rationalized, reasonable, fair playing field for distributed energy would do a couple of things. One is it would encourage more DER investment, because they would get a higher rate of return for investing, and it would save the DER consumers a significant amount of money, because they would be buying locally and they'd be avoiding much higher costs. You could alter this picture and carve some of this value, this economic rent, out and provide it to those that are not involved in the transaction as well. So I think this is an example where simple, maybe not so simple, but reforms of price signals that are out there could fundamentally unlock a lot of potential economic value and ultimately lead to a more efficient system investment pattern. Thank you.
Thank you, Ezra, for those comments. Now, I'm just going to draw our audience's attention again momentarily to Slido. I hope everyone has managed to connect themselves. A number of people have, and we're starting to see some questions popping up, which is fantastic. If you've not yet got yourself connected to Slido, just go to slido.com and type in ESIG-1A in the little box and you'll be connected with us. I want to just draw your attention to the polls as well as the question feature. Now we've put a little poll here, just a simple question. Does Australia's current market design of the NEM need, and then there's 5 choices, only minor adjustments, major changes, a complete clean sheet approach, should it be abandoned and full central planning restored, or don't know? So we'd love to hear your responses to that question, slightly entertaining, slightly provocative, and it'll give us a feel for, you know, what's the range of views that we've got among the audience today. While you're doing that, and while you're putting your questions, your own questions into Slido, which we'll come to in a moment, I had a few questions that I wanted to ask our speakers. And the first one is to Bethany. That actually the first one was, I think, already reflected in the Slido question panel here. Bethany, is NREL planning to make the new electricity modelling suite available to third parties, and when do you think it might be ready for release?
Yeah, that's a great question. I meant to mention that, so thank you for asking. Yes, we are doing an open release or open access. I'm not sure the exact which one of those it'll be, with an initial release actually at the end of this month, the end of September. The formal kind of project ends at that point, and so I should mention this is in Julia, the software language, and so it requires some knowledge of command line and being able to go through the scripts. So it's not going to be like a GUI interface where you can just click on and toggle different pieces. So there will be some sort of understanding of scripting and command line controls to be able to use this. But we are hoping to have follow-on work and continue to improve and enhance the sort of kind of initial version that we have here. And have already sort of flagged some of the pieces that we'd like to improve.
Yeah, okay, that's really good to know. That gives a much more complete picture. Bethany, you made the case quite strongly that you think there is a role for models and simulation tools and software in thinking about, in informing questions about market design. Are you getting buy-in at NREL from stakeholders in the US about the use of this tool in particular, or tools like it, to inform market design?
Yeah, I mean, we have a small advisory committee that we've been engaging with just to get feedback on, mainly more from a model development perspective of prioritizing the features and capabilities that we should be incorporating. But there's other projects that we're working on as part of the Department of Energy funded work that we primarily do, where we are engaging directly with the 7 main US-based ISO and independent system operators to help prioritize the key market-related challenges that they're seeing right now, and specifically ones where we can, as national laboratories or other parties involved in that particular project, use the tools that we have to help inform those issues. And, you know, these ISOs, they have stakeholder processes of their own. They have proprietary software. They have their own specific system with their specific existing set of market mechanisms. And so the type of work that I think we would do with this particular EMIS tool, you'd have, if you wanted to focus on one specific ISO, you'd have to have very specific data for that ISO. But I think there's a lot of higher level, more generalized insights that we can gain about some of these broader concepts that can be translatable between different ISOs or different market areas where they might have different kind of starting points with their existing design, or at least that's the vision that we have. But we have some of there's a handful of ISOs that we have talked to in more length about this particular tool, and they're excited about the ability of connecting the operations with the investment, because that kind of longer term view with market design being the kind of basis of that is something that I think they're realizing, as many of us realize, right? It's becoming more important. Historically, we've just taken kind of static systems with a production cost model and thrown it at the model and said, okay, what do the prices look like? And try to get little bits of information from each, from many different runs. But we want to see the feedback effect on how that determines what gets built.
That's really essential if you're in a market world, I think. And I think there was a point sort of somewhere in your presentation that there's often a sort of there's a little sort of central planner guy hiding in the software code in a lot of models, and I think that's something that we tend to overlook. Okay.
Yeah, we are. Yeah. Oh, I'll stop there.
Yeah, no, that's good. Now there was a little comment that you made, Bethany, and I'm actually going to use this as a segue to the next to questions that I've got for Julian and then for Ezra. And the little quote you made there, which I wrote down, was, "We can't guarantee reliability with marginal cost pricing, or maybe with only marginal cost pricing." And there was one of our audience had missed the link to the pre-reads and maybe was not the only one, but and Taru has kindly put the links in the response to David's question in the chat window. It was included in the announcement for the webinar, but perhaps not easy to spot. But Bethany's comment there about reliability, that marginal cost pricing doesn't by itself guarantee reliability, sort of really challenges the viewpoint piece by Bill Hogan from last year. As I think Bill seems to be arguing that the market will naturally transition from a sort of marginal cost pricing economic textbook approach to just to scarcity pricing and abundance pricing. So in Australia, of course, the wholesale market can go all the way up to $15,000 per megawatt hour, and down to minus $1,000. And Bill Hogan seems to be arguing that's fine. It's just another type of pricing dynamic. So I guess that sort of leads to my question to you, Julian, is that, you've talked about the importance of essential services. And I guess the question in my mind is, are you thinking that these things will sort of somehow plug in naturally to the existing FCAS markets, the frequency control and ancillary services markets that we already have, which I briefly outlined at the start? Or do you think we need other new markets in addition to those markets?
Yeah, thank you, Stephen and Bethany. I think the answer depends on the service. If you're looking at something like fast frequency response, we have a rule change in front of us that is proposing that we have a spot market-based price for fast frequency response, and that could work quite well, and we're evaluating that. But I don't think at this stage it works very well for something like fault level or system strength, where it's much more locational. It's very difficult to even define what you're talking about. We have long discussions about what system strength actually even is, let alone how you can buy it in a 5-minute time frame. Also, a lot of the existing providers of these services are things like synchronous machines that you can't just turn on and off every 5 minutes as you need them, and they may or may not even be located in the right location. So those sort of services we at least initially thinking about procuring through contracts and network assets, which is, as I talked about, being coordinated by AEMO and the network businesses.
Okay, thanks, Julian. And Ezra, I'm going to pick up something from Julian's slide, which was, he talked about the 4 Ps, and 2 of them were planning and pricing. And I can't help noticing that your first degree involved philosophy, and of course the first economists called themselves moral philosophers. And it seems that when Julian says something like, we struggle to define, we struggle to define system strength, and it seems difficult to imagine we can devise a market for something that we can't define. So I guess my question for you, Ezra, is that philosophically, do you think it's possible to marketize everything? or is there a sort of a point somewhere where we end up having to do central planning? And how does that relate to your view about distributed energy resources and the new world that you described?
Well, there's a few questions in there. Look, with respect to can we create a market for everything, I think markets have their limits. I think one of the biggest things that I have become more open to is that markets are imperfect, and there's a constant challenge in creating a level playing field. And I mean, the reason we do markets is largely for choice and competition. And if you can get strong competition, it drives innovation, it drives cost reductions. It's what we're aiming for. But you've got this other problem of regulatory capture. And so, you know, it's an imperfect world that we're dealing in, and we're struggling to find, well, what's the right balance and the transaction costs of the design and even getting to that design. So there are a lot of good reasons why it's hard. And this is, you know, the electricity system is one of the most complex things out there. I mean, people have called it the biggest machine in the world is the electrical system. And there's all kinds of complexities in there. However, I will say this, the system needs to reform, and it needs to reform for the reasons that most people point to, which are unsustainable environmental impacts. But the one that I have foremost in my mind often is it has to reform because there's other technology that is already emerging that will enable people to just opt out. The microgrid is closer and closer, and my calculations are that it's going to be able to deliver 24-cent power in the next 3 to 4 years. And if this system doesn't get its act together, people are going to just run off of their own systems, and that'll be a much bigger issue to deal with. So, you know, we're fiddling while Rome's burning, and you know, I hope everybody bears in mind that there is this alternative that's out there that's a stalking horse and helps us focus on trying to make good decisions as quickly as possible.
Yeah, that's interesting. So that there's a question here from Andy Boston, and g'day to Andy, which has been voted up to very near the top of the list, and I think it relates quite closely to what you were just talking about, which is and it's for you, Ezra. If DER, consumer and producer, only pay for low voltage network costs, doesn't the transmission grid eventually become stranded? And I think you're saying, if I'm understanding you correctly, I think you're saying yes. Should it be paid for the services it provides, backup power, frequency stability, fault current, black start, etc.?
Yeah, look, I think one of the biggest challenges that another big challenge is not encumbering our children with a lot of really bad decisions that are being made at the moment that are waving through billions of dollars of investment that are going to potentially be stranded. What do we do about that? I think just more specifically to the question that was asked, though, is as an economist, I believe that we should always be aware of what the costs are and that those are fairly and equitably allocated. Right now, they're not by a long shot. Whether you want to go to the specifics of how the transmission pricing is set up to how it's actually implemented, and it hasn't really mattered because there's been no alternative, right? Whatever the AER says goes. That's changing. There's technology that's emerging that's going to mean it doesn't matter if it's a good decision or a bad decision, but if it's an inefficient decision, it's going to be bypassed.
Yeah. Okay, there's another question that's got a lot of votes here. It's from it's an anonymous question, and it's posed to Julian. What sorts of dynamic responses are more required and should be integrated into the market in renewable-rich systems? Should we focus on current frequency/voltage responses, or there might be a need for some new services like damping responses, PSS-like responses? Julian, have you got some thoughts on that question?
Oh, yes, thank you. I'll answer the last bit first. We've been looking at damping quite a lot when we've been looking at system strength. And we see that more as a demand side tool, because what damping provides is you need to provide less system strength if you're damping oscillations out. Also, power system stabilizers operate at quite a different range of frequencies to what we've been looking at. With power system stabilizers operate in and around 1 hertz or even less. The frequencies that we're seeing with inverters are much more like 6 to 12 hertz, more that sort of range. In terms of dynamic responses, I think it's important to specify what the system needs, and then when that can be defined, then you can design markets around that. And it's AEMO's work is identifying increasing needs for faster frequency responses, especially, I mean, when we'd made some rules in this space about 3 years ago, and at the time, fast frequency response was only really regarded as a problem when you had a non-credible contingency like a separation event where part of the system is islanded and you get some very rapid changes in frequency. But now it's emerging that even when the system's intact in the largest generator trips, that the frequency can change relatively quickly, and the existing FCAS will either be too slow or you'll need lots and lots of it to be able to manage the frequency.
Yes.
So we are looking at how we can incorporate fast frequency response.
Yes. Bethany, Julian touched briefly there on responses from the demand side versus responses from the supply side. And there was a comment or a question I noticed somewhere here a little bit earlier that I think we as industry people perhaps tend to talk about demand in the abstract and in the sort of the absence of the customer. And I was just wondering, Bethany, whether, particularly given the topic of your PhD thesis, whether you're doing any thinking at NREL on the relationship between the demand side and the supply side when it comes to questions like, you know, system strength and stability and reliability, and the role that is, you know, are you seeing a role that customers might be playing in that?
I'm not personally involved in any projects at NREL right now working on that, but I know that there are folks looking at demand side opportunities and grid stability. So I personally can't speak to that right now, but I know there's work that's heading in at least that, broadly speaking, that direction. And I know at least for the EMIS modeling tool that I discussed today, we're hoping to, at least in the future, incorporate more of the demand side response piece, because we do see that there's obviously opportunities. That was one of the flaws that I mentioned in that last slide, that back to the quote that you took, that marginal cost pricing alone can't guarantee cost recovery because of those flaws. That inability of the demand side to see the actual price of electricity and to be able to respond appropriately is one of, I mean, that's arguably the biggest flaw, and one that is at least in part solvable.
Yeah.
So I think there's a lot of opportunity there.
Yeah. So in Australia, we've got this amazingly potentially very powerful wholesale price signal, and we allow it to move anywhere between $15,000 a megawatt hour and minus $1,000 a megawatt hour. But of course, the risk that entails for small consumers is so large that that's one of the reasons that most people don't see that price signal, because if they were exposed to it, they would be at risk of bankruptcy on a sort of almost daily basis. I'm wondering whether either Ezra or Julian want to sort of give any views on that. You know, how do you sort of engage the demand side without bankrupting people?
I was just wanted to clarify something I said earlier about demand side. I was actually thinking of demand side for the actual system services. This could actually be what you would call the supply side of the energy market. But yes.
I see. Yeah. I'm not sure I quite caught that, Julian. So can you just unpack that a little bit for me?
I'm saying what's on the supply side for the energy market is the renewable generation, but it's actually on the demand side in terms of the requirements for system strength.
Yes.
Yeah, sorry.
Yes. That's a very subtle distinction. One of the thoughts that's occurred to me, and it sort of perhaps links across some of the questions here, is that when the market was originally designed, there was this sort of basic idea, which I call the wall of separation, where on one side of the wall you had energy generation, and that was a competitive market thing, and on the other side of the wall you had networks and natural monopolies and all those things, and that was a sort of a regulated thing. And we seem to be moving into a world where these two things are blurring together. And I think that that's an issue when you start talking about distributed energy resources and you start talking about the sort of network issues that have been touched on. Ezra, do you have any views on that sort of blurring of the boundary? And it tends to become quite prominent when you've got zero marginal cost generation. In other words, it's all fixed capital.
Sorry, can you?
Rephrase.
I'm not sure I understand the question.
So, okay, so the energy market and the networks have been sort of held completely separate from one another until now, in the way that we've sort of conceived of electricity markets. We start blurring them together. So we start letting distribution companies install storage and play in the energy market, and then how do we, and then start blurring that with their regulated asset base? And it seems to me like there's some really basic things here when it comes to questions of market design that become quite tricky.
Yeah, I mean, I think this is one of the big challenges in that distributed energy can substitute for both network and generation.
Right.
And to the extent that the network is owning and operating distributed energy, they're competing with other resources. It really blurs the line between who's providing the platform and who's competing on that platform. I mean, I think that's all manageable through regulatory instruments that we're pretty familiar with, but you do have to be more cautious when people are changing hats and now they're no longer on the platform side but in the competitive arena.
Yeah, so there's a question here from Tim Ryan, and he's addressed it to you and to Bethany. With respect to DER, currently there is significant cross-subsidy of DER owners by non-DER in Australia. DER owners' avoidance of network charges. Should the basis of tariff be full charge for network, demand rather than volumetric, and incentivised to earn back to recover that cost?
I'm happy to have a first crack at that and hand it over to Bethany. I mean, economic theory tells us that we need to send signals if the market's not doing it on a regulatory basis based on user pays, and if that doesn't pay for it, then you've got to allocate those residual costs in a Ramsey pricing sort of way if you want to be efficient. There are I'm not sure what we mean by cross-subsidy as owners by avoidance of network charges. If I have solar on my roof and I don't use the network, I'm not sure what that means. But can we reform network tariffs to reduce the amount of cross-subsidies? Absolutely, and that's some of the work that we've been involved in to a large degree. I mean, the pace of regulatory reform in the tariff arena is glacial. I mean, I was tariff manager at Osgrid or Energy Australia 13 years ago, and almost nothing's changed.
Yeah.
Bethany, what are your thoughts?
Did Bethany?
I'm not sure that I can contribute much to this question. I don't think I have the answer. I mean, I know we've done some work with looking at retail rate structures and linking that back to capacity expansion modeling. And certainly those rate structures impact what gets built, but we've also seen kind of a one-to-one trade-off between distributed PV and utility scale PV in what gets built. So there's sort of just a substitution effect that happens in that modeling. But I certainly don't have the answers on retail and DER rate structures.
Bethany, does the model prefer distributed rooftop PV or utility scale PV?
What we found was, so I'm thinking back to some work, I mean, this was several years ago now, with REEDS, which is a different capacity expansion model. That's one of our sort of flagship traditional central planner, minimize cost, linear programming tools that I mentioned or alluded to earlier.
Yeah.
And so in that one, we have a separate DGen model that that determines the deployment of distributed PV. And so what we, sort of our default operation is to run dgen to come up with the projection for distributed PV and use that as an exogenous input into reads to then determine sort of the rest of the system build out. And so we were playing around, and Peter Gagnon is the one who led this work. I just helped in a very small role, so he gets all the credit here. Worked to look at different retail rate structures and how that would impact the deployment from the dgen side, and then the resulting impact from the reads deployment with everything else. And so the point I was just making was that we often see kind of high level a substitution of if you don't build as much distributed, you build more utility to kind of get the overall same amount of solar. That's a very high level generalization. I'd have to go back and refresh my memory on the nuances from that paper, but
yeah,
there's a lot of work being done in this space that this is certainly not my area of expertise, so I don't want to.
I've just taken Tim off mute as well. I'm not sure if you want to make a comment, Tim.
Yeah, I wouldn't mind. Look, the point I suppose for our overseas participants in this is we have a problem that the major driver of people subsidising or deciding to use PV is that it avoids the network tariff costs, which are the actual majority part of our bill. And if you look at Richard Thaler's work on nudge economics and behavioural economics, etc., one would suggest we'd be better off having non-volumetric charging and properly charging DER owners for all their network facilities they use, so black start, frequency, voltage, emergency supply, the fact that it's there when the sun doesn't shine, etc. And then give them the opportunity to earn the revenue, earn money back for the services they provide. And when you think the fact that most of our PVs be subsidised by government, one would hope that there's an obligation on the people that have this to expect that they should contribute in some way to the community rather than being, for the want of a better word, freeloaders.
Did you want to respond, Ezra?
Look, I 100% agree that the current incentive arrangements in Australia, but almost everywhere else, are not cost reflective and have these cross subsidies, etc. Charging for network usage should have some relationship to your contribution during the time of the day where it's likely to drive an increase in demand. And there's mechanisms for how you recover costs if that doesn't do it for you. So I mean, I agree with what you're saying. Yeah, we'll stop.
It's interesting how many of the questions and how much of the discussion is sort of moving from market design to issues around how networks are priced. I think that's sort of a general observation. Taru, I'm very conscious of time. We've come to the top of the hour. We've, of course, not been able to address all the questions. Do you want to keep, and people who need to sort of go to another commitment, obviously, will do so. But should we keep this going for a little bit longer? Do people want to continue the discussion, is my question.
I'm happy.
Yeah, panelists.
Yep, so maybe we can go for another 10 or so minutes, and then what we can also do as well is any of the questions that are unanswered, I can pass them through to the presenters, and then we can have some responses sent as well.
That'd be really good, because I think one of the benefits of this kind of session is if we can sort of make connections between people and have follow-up conversations. I think that's beneficial to everyone. So David Havyat has asked a number of questions, and I'm wondering if you could, if David's still there, if you could open David's microphone. David, the question I'm looking at is your 834 question to Ezra about the incentives for DER investment.
I've taken David off mute, so hopefully we can hear from him.
You there, David?
Yeah.
Maybe he's had to go.
Yeah, no, that's unfortunate.
Yeah. Okay. And I thought there was a question. It was an interesting question for Julian somewhere that Well, okay, there's an anonymous question for Julian. Julian, are you confident that new market signals are an appropriate mechanism for orchestrating power system stability?
Well, we're not confident at this stage. We are looking at predominantly procurement through the AEMO and the NSPs planning and procuring what they need, and working it that way. The exceptions are for like any reserve-based services, which can be easily integrated into the spot market. So really, it's a matter of doing that, because that can be done more quickly and with more certainty, and then monitoring that. And as technology changes and different business models come up, we can look at whether it is possible to integrate it back into the market. So that's probably a long-term question.
Yeah, okay.
So David looks like he's saying he can speak. We can try that again, maybe.
Okay, open his mic, let David speak. He's been very patient. He's asked a lot of questions. David,
Yeah.
I'll give you the choice of question.
I know.
Go ahead, David.
Now I'm sure.
Here we go. Try again, David.
You can hear me now? Good.
Yes.
Look, my choice of question, if I could go back to the DER question, which was about the DER investment one, it's sort of it was just a sort of throwaway comment in relation to Ezra's suggestion that said the benefit of his pricing reform would be that we'd increase the amount of the incentive for DER investment. And looking at the current issues in the NEM, it seems to me to be, at least from a NEM point of view, that the last thing we want is more investment in DER. I'm not saying I agree with that NEM point of view, but given the fact that the significant issues we're now facing of minimum demand being too low and AEMO seeking the power to turn off DER at certain times of the day because it's causing system problems, are we really in a world where our focus should be on incentivizing more DER until we've actually worked out some of the other system strength and system security issues related to DER, and that's the higher priority. That's the question.
So a couple of things. One is we're sort of in this mess because of the poor signals involved, which doesn't mean that you don't try and fix those signals. And because we have these lack of signals, right, or the signals we have, people are maybe it could be said over-investing in solar exclusively, and maybe with the right signals, they would invest in electric vehicles or storage and trade with their neighbors if that was the most efficient way of doing it. And that's what they wanted to do. But the situation we're facing at the moment, which Tim pointed out, was that we've got these cross subsidies. I mean, the state of pricing in this industry is medieval, for lack of a better word, and we really need to, deal with that if we're going to have any hope of getting the right outcomes here. And again, I sort of feel like the industry is going to have to go through a lot more pain before we're going to have the institutional focus for fixing what needs to be fixed.
That I agree with. No, I won't ask the second question.
Is it too provocative?
Yeah.
103 people looking.
Yeah. All right, look, we've gone a little bit over time, and Teru's kindly sort of given us a little bit of extra time, but I guess I might just ask each panelist whether they've got any final word that they'd like to sort of wrap up or conclude with before we call the session to a close. I might start with Bethany. Is there anything that you sort of take away from this that you'd like to share with us?
I mean, I think this is just in general for market design. There's a lot of work to be done, and I think none of us have the answers, and so there's time to roll up our sleeves and keep going.
Well, thank you, Julian.
in my comments, similar, sort of following up a wee bit from what David said, the understanding of the power system is evolving at one rate and the market design is going at another. Then there's a lot of government incentives for different behaviour, and trying to keep your head around all of it, just impossible. And you make a decision, you progress for a while, and then you have unintended consequences, and you have to be constantly, which is good for my job security. I think I have a job for life, so it's good.
Great. And Ezra, have you got any concluding comments?
Well, it really, first of all, thank you for the opportunity. I think these sessions are so important, especially in our current situation. But, I know it's really difficult to hear, but I would urge everybody to consider where technology is headed and what we're going to do if we don't take that into consideration.
Yeah. Okay. All right. Well, my concluding comment is that the discussion has confirmed my thoughts that this is a very complex area and that no one has all the magic answers, and a lot of serious hard work still remains ahead of us all. So I'd just like to thank Frew for her hard work and that of her colleagues behind the scenes, Christian and the others at AEMO, and thanks to all the folks at ESIG, to Mark and Charlie and everyone who are the driving forces behind ESIG for making this possible, and encourage you all to tune in to the forthcoming events in this series. Thank you very much.
Thank you.
Thank you.
Thank you, Stephen.
Thanks, Stephen.
Cheers.